Welcome to TheoTrade. This is Don Kaufman. It's November 5th, 2018, and you are watching the TheoTrade evening video. Markets are just moments away from closing and are displaying some fairly significant divergences prior to, of course, the November 6th, which is tomorrow's election here inside of the United States. S&Ps are up 14, or better known as 0.5%. Nasdaq futures are down about 0.5%. The Dow is up 0.75%, and the Russell is massively unchanged. So if you're curious as to what I kind of determine as, again, divergent, this really to me looks like, again, kind of confusion prior to the election. However, at the exact same time, if you start to look at what we term the monsters of tech, well, the beatings shall continue until morale improves. The monsters of tech, which is the collective of Microsoft and Apple and Facebook and Amazon and Google, is down about 1.3% today. But in a larger sense, what you're getting is the monsters of tech now on a year-to-date basis are only up about 12%. The point of that is to mention that the recent high, they were up just over 30%. So we're now falling back. If you look from absolute high to current value, just shy again of what we term like the bear market territory in the monsters of tech as a whole. There may be a little bit of an opportunity forming, however, in a product like Microsoft, because if you look again at the market cap leaders of what we kind of turn, again, what was originally termed the FANG stocks, we here at TheoTrade call it the monsters of tech. Apple, again, cracking a little bit lower on iPhone kind of production possibility cuts. Nevertheless, Apple still up 17% at a year-to-date basis. Facebook, day in and day out, it's just hideous out there, down about 18%. Amazon also kind of taking it on the chin today, nevertheless, still up 37%. And last but not least, out of the monsters of tech, we actually have Google, which is, for the most part, flat on the year, effectively down about 1.6%. The point of me going through on a percentage basis here is to identify that if the markets are going to see continued volatility, place fundamental analysis aside in any assumptions here, place whatever you think about Microsoft aside. If large cap underlyings, okay, are going to see volatility, it is only a matter of time before these trading firms and these quantitative firms specifically start to turn their algorithms and go after an underlying like Microsoft, which once again is now the outperformer in this pack, okay, that we term the monsters of tech. Now, as I mentioned, the market almost looks like it's in a degree of confusion with the Nasdaq down and the S&Ps up and the Russell relatively flat and the Dow flying a little bit. But one thing that it kind of begs to be recognized here is if you take a look, and what we're doing is we're just zooming into the S&P E-mini futures. I wanted to display to you the volume, okay? The volume in the S&P futures, and again, we're seconds, literally seconds before the closing bell. Here is where the current volume kind of rests on today's trading session. It is the lowest volume, effectively the lowest volume that we've seen anytime since the volatility really kicked off kind of in early, again, here's early October. So what are we really looking at today? A little bit of kind of a mulligan. It's, tomorrow it's a do-over. Nevertheless, even tomorrow, as we come into Tuesday, I wouldn't expect, okay, any of the election results during market hours. That's going to happen, of course, late in the evening as things start to actually unfold. And really, the risk of the election lies more into the Wednesday kind of time frame. So we're looking today at a marketplace that's divergent, almost confused. You're seeing the S&Ps, though, have very, very light volume. So again, we kind of say, today is a little bit maybe of not so incredibly important. We've kind of been, channeling in and around throughout the course of the trading session, 2731, which happens to be effectively one of our gravity points. However, all this being said, I want to show you something that I found rather astounding today. So we've already looked at a position possibility here in Microsoft, and again, a possibility of a short position in Microsoft sometime in the near future. I'm going to bring up a couple more positions here momentarily. But before I get there, I'm talking about this divergence that kind of continues in the market. There was something I saw earlier today that I found incredibly alarming, and I want to bring it to your attention. If we go over here to the Market Watch on thinkorswim and we look at the advanced decline line. First of all, this is the S&P 100. I mean, it's what really matters, right? You talk about like, oh, the S&P 500. Yeah, but hey, listen, Apple and Facebook and Amazon and Google and Microsoft, come on, those are the products that really make the difference. They're the market cap, monsters out there. It's why we call them the monsters of tech. And looking at the other 400 stocks in the S&P 500 doesn't really make a lot of sense. All right, so we look at the S&P 100. Look how stellar the advanced decline line is. Okay, it really is, again, a stellar advanced decline line inside of the S&P 100. With that in mind, you can even kind of cruise over to the Nasdaq 100. Now the Nasdaq today fell, okay, but it fell again on a positive advanced decline line. It displays, okay, the power, if you will, of market capitalization. How much impact an Apple and Amazon or Google can really have on a broader marketplace. However, what I was talking about a moment ago is something that I found rather astounding and yet alarming at the exact same time. I'm going to show you a screenshot right now, and this screenshot was actually taken earlier in the day. So we're all clear here. Right now, we've just come to the cash close of the marketplace. I'm going to kind of go now. This is now a screenshot. This happened to be, earlier this morning. It was about 8 a.m. I'm now on Mountain Standard Time. Take a look at the advanced decline line here with 80 advancing issues, 82 advancing issues to be very, very specific in the S&P 100, and the S&Ps themselves only up to. That should be and should feel incredibly alarming to you that an advanced decline line can be that strong. And yet the marketplace was sinking at this particular moment in time. And again, it really just resonates with me of the risk, obviously, that persists in this marketplace. So that screenshot was taken, right in this neighborhood here, all right, when the market had already bounced back up to a degree. Nevertheless, that strong and advanced decline line with a marketplace that can't get out of its own way is incredibly worrisome. And you say, well, why? Why is that so, intimidating? Could you imagine if the other 80 stocks started to see some sell-side activity? The S&Ps could easily be down 80, 90, 100 handles. And that is why it's so intimidating from purely a risk-reward standpoint. Now, to point out a few bright spots in today's trade, you have to look over at the financials. The financials ripped higher inside of today's trading session, and they got above, and you can see I'm working one more in here, they got above this threshold of 2650. How did they effectively do it? Because the way I look at it, Goldman Sachs actually had a down day. If you look at some of the other financials on the board, you've actually got Bank of America. It's only up 0.6%. JP Morgan, 0.6%. Citi outperformed. Wells Fargo was unchanged. Morgan Stanley was down on the day. How? How is the XLF up 1.5%? There's only one answer to that. It's Berkshire Hathaway. Berkshire Hathaway had earnings over the weekend, and the Berkshire Hathaway earnings lifted the XLF. Why? Because Berkshire Hathaway is one of the largest constituents of the financial sector, specifically of the XLF. Nevertheless, took a huge amount of market cap and pushed it to the upside. So when you're looking at the S&P futures and you're seeing them up some 17, a large portion of that, again, was a mega market cap inside of the financials, that lifted the broader marketplace. With that, we also had energy stronger on kind of a relative basis. Other than that, through and through, a lot of big sectors, a lot of big market cap got whacked. Namely, of course, our monsters of tech. Now, another position that I want to go over before we kind of move on, and of course, tomorrow during the election. Again, I wouldn't expect a tremendous amount prior to Wednesday. In fact, while we have a moment, we'll cruise over here to the SPX. And the reason I'm going to the SPX is just to read into, some of the angst, if you will, surrounding this election. There's a lot of individuals, that are mentioning how wild some of the volatility may be around this election. And again, I think it's incredibly built up in the media, but let's see, and let's put that, I think, a little bit in check. And to do that, all I'm going to do is just highlight, here's a Wednesday expiration and a Friday expiration in the SPX. Okay, does the volatility look wildly elevated? No. 22, 23%. Does the expected move look incredibly scary? Absolutely not. What are we looking at here? With 4 days remaining to expiration to Friday, we only have a $56 move. I guess the interesting irony of that is we already had about a 30-point move just in today's trading session. So between now and the close of Wednesday, we're looking at a $43 move. So I think you really have to kind of, maybe quiet down and knock down some of your expectations of almost like this election phobia. We have a marketplace that's displaying lower liquidity today. Yeah, maybe it's waiting for the election, but nevertheless, hey, listen, tomorrow, Tuesday, if I come in and I see this volatility start to take off to the upside, all right, then might get a little bit nervous. But for right now, okay, you got to trust the expected move. You got to trust the implied volatility. And why, you might ask? Well, you don't just look at the volume and open interest. Okay? Why would I look at the volume and open interest? You know what? Look at the Friday volume and open interest. It's astounding how many options are even traded in here. You have to recognize that, all this open interest, there are literally, billions and billions of dollars at risk. And that's why we trust the implied volatility, because every contract that traded in this particular product, for this expiration, goes to calculate this implied volatility. I mean, that's effectively how markets function. And if you see tens of thousands of contracts that are not only open, but tens of thousands of contracts being traded in here, rest assured, this is what the marketplace, really perceives that risk to be. Last but not least, we're actually going to cruise over to a position on CSX. This is a duration position that I have just created and executed. CSX has actually seen some sell-side activity recently. If we look at it on a year-to-date percentage, it's still up 22%. Kind of ironically here, if you look at it on a 3-year basis, it's pretty wild. I mean, this isn't exactly like reinventing the world. This is not the latest, greatest tech stock. What do? They're like, well, we bring goods from point A to point B, and it's a train, people. But I'm not into the fundamentals. And I'm not actually going to knock, transports or anything like that. In CSX, it's very, very simple. This is about, again, a rotation of capital. And what we see is this looks like one of these quintessential rip-your-face-off rallies that will be sold into. As such, I have elected to take a duration position. And in selecting this, I used a deep-in-the-money put that I purchased. Now, when I purchase a deep-in-the-money put, I like to be very, very clear about this. I go after an 85 delta or greater. We selected the January expiration, 85 delta or greater. That takes us to the 80 puts. We are purchasing these puts. The bid-offer spread is wide. Fight the marketplace. Don't go after mid-price. Do better than mid-price. What that effectively means is you don't try to fill this thing at 11.25, right? If the marketplace on here is 10.85, 10.65, get in there and work that thing right. Work it at $11. Work it lower than $11. That's, again, what this business is about. Don't give up edge to the counterparty. This trade, in CSX, we're going to sustain it for a very substantial period of time. This is what we call a duration position. The intentions are holding this position for beyond 3 months. Why? I want to be short. And I don't want to be short in the near term. I want to be short. And that means, listen, I'll be short pretty much till the cows come home. Call me when this thing gets down to 50, and I might get excited about the project. With that, I want to thank everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.